Good. Okay. I think we can get started. Good afternoon to all of you, and a very warm welcome, and good day to those who are joining us online, depending on what time of day that is, wherever you are. It's good to see so many familiar faces, and also really happy to see some new ones as well. Thank you very much for joining us today, and thanks also to those who are joining us online. I'm Topo Elewani, for those who might not have met. I'm co-CEO of Helios Fairfax Partners, and also co-founder and managing partner of our investment manager, Helios Investment Partners. It's a real pleasure to be here with you all today. But I'm not alone. It's by no means a one-man gang. I'm joined by 4 of my fellow HFP officers, whom I'd like to introduce now. First is my co-CEO and co-founder of Helios, Babatunde Shoyoye, who's over there. Second, Luciana Geminario, who's the Chief Operating Officer of HFP and also of Helios. Third, Belinda Blades, who's our Chief Financial Officer. And last but by no means least, the one who keeps us on the straight and narrow, Julia Gray, who's our General Counsel. I'd also like to introduce our non-executive board of directors and non-executive members of our board, 3 of whom are with us here today, I believe. I think you already know Chris Hodgson, who's our lead director and chairs the audit committee as well as the governance committee. And also Chris is sitting right there. Thank you, Chris. And also Quinn McLean, who is represented from our partner, Fairfax Financial. I think most of you know Quinn, and there he is. But we do also have one very important new joiner, whom I think many of you have not met, Kathy Cunningham. So Kathy is CFO of the Globe and Mail, which needs no introduction. It's Canada's national newspaper. And prior to that, she was SVP at Sun Life Financial, and she has a background as an auditor. So she brings extensive and highly relevant experience to our board and has joined the audit committee. So please join us in giving her a very warm welcome. Thank you. And if we ever get any unflattering coverage from the Globe and Mail, you know who to hold responsible. Yeah, well, we'll see. All right. So our agenda today will be very similar to last year's. First, we'll start with a quick refresher on Helios Investment Partners, our investment manager, and then we'll review our strategy for value creation. We'll then get into depth, probably more depth than in prior years, in evaluating our performance in 2023. And we'll give you an opportunity to ask questions along the way. By the way, on the questions point, for those of you who are online, to the extent that any questions occur to you as we go through the day, please feel free to send them in, and when we have the Q&A sessions, we'll just, we'll be able to run through the questions that you would have posted by then. So there's one global message that I would like to convey today, and in some of our chats in the lead up to the meeting, I think we've talked a bit about this, but really the one global message I'd like to convey is that we're now at a positive inflection point. We've turned the page, as you'll see later on the legacy issues of the past, both portfolio-wise and otherwise. And we're very confident now that HFP is on track for a very bright and exciting future. So that's the overall global message I would love to leave you with today. But beneath that message, there are 3 specific points. The first is that we've made huge strides in liquidating the legacy investment portfolio. And we've done that actually at a very high, I guess what we call recovery rate. So this was not some fire sale, just get rid of it kind of thing. We've actually been able to exit this portfolio at pretty high recovery rates, if you will. So that's the first point. The second point is that then, of course, the new Helios managed investments into which we've deployed that capital that we realized are performing very well. And we think, again, that the track of those should continue to be attractive. We expect to see even improving performance from that portfolio. And then the third is that with the various new funds that Helios is in the market to raise right now, the prospects of us growing our share of the fee and carry income streams and therefore achieving operating profitability, i.e., having fee income that exceeds the cost of running the overall HFP business, are better than they've ever been. So these are the key messages and that I hope you'll take away from our conversation today. So first on Helios Investment Partners, and just a quick reintroduction. Helios recently celebrated the 20th anniversary of its founding in 2004, and their journey so far has been marked by several milestones. Helios raised its first institutional private equity fund in 2006, its second one in 2010, the third one in 2014, and the fourth one in the pandemic year of 2020. 2020 obviously also marked the year of the strategic transaction that created the HFP that we know now. And from 2020 to 2022, Helios began the work of really transitioning from a single product, i.e., private equity, a single product investment firm, to a multi-strategy investment firm. And the manifestations of that transition have followed. So the Helios 7 Rivers Fund, which is the hedge fund, and we'll describe that in a bit more detail later on, and Helios Sports and Entertainment Group were both launched last year, actually, in 2023, and they're both off to a pretty good start, as we'll see later on. And this year sees the launch of Helios's fifth PE fund, fifth private equity fund, its venture fund, Helios Digital Ventures, the first Helios Digital Ventures, and its climate fund, which is called Clear. All of these are currently in progress. And along the way, the firm has received numerous awards in recognition of their work on the continent. Private Equity International, for those of you who may not be aware, is the leading global publication for the private equity industry. And their awards are the industry's most prestigious. I don't remember when PEI actually started awarding an Africa Firm of the Year award. It was probably maybe 10 years ago. And in those perhaps 10 years, Helios, I think, has won the award probably 7 times, including each of the last 5 years. So that's relatively, well, it is unprecedented, and that's something I can tell you that the Helios team are quite proud of. Now, PEI's awards are mostly about performance, reputation, and so on. But for those of you who know, those of us on the Helios Investment Partners side and here as well, driving sustainable, positive socioeconomic impact on the continent is pretty core to Helios's mission, just as it is to HFP's. And on that score, we're pleased to share that Helios recently received the GPCA Social Impact Award for their investments in Solevo. Solevo is an agricultural inputs and industrial chemicals distribution business that Helios bought in around 2016 or so and sold a couple of years ago. GPCA award recipients are selected from across all emerging markets, not just Africa. So it's Asia, Latin America, Eastern Europe, as well as Africa. So winning that award is a pretty big deal, I think, for those who care about socioeconomic impact, which we do. And I can tell you that, again, the team at Helios is extremely proud of that. And at HFP, we are equally proud to be associated with it. So that's a little bit of context on our investment manager. So now let's recap our strategy for value creation. I hope that much of the slide that follows will be not new news. If it is, then we clearly didn't communicate properly last year, but I think it'll all be familiar. So we'll recap our strategy for value creation. It comprises 3 simple steps. The first, which I've alluded to already, is to liquidate the legacy investments. That's point number 1. And then next, points 2 and 3, is to deploy that capital that we've freed up into 2 activities. The first one, that's point 2 on this page, is to invest in new high potential investments alongside Helios's funds. And the second, that's point 3 on the page, is to stimulate the growth of our fee and carry streams by seeding new fund strategies that are synergistic to Helios's existing businesses, Helios's existing strategies, and that align with the interests of the LP community and therefore are able to attract fee-paying third-party capital. So again, I hope none of that's new. This is the framework we set for you last year. Hopefully by next year, the first bullet point would have gone away to be replaced by something else. But that's the framework. But what is new is this, actually. This is not something that we've covered before. As I mentioned at the outset, given the significant progress that we have made addressing the issues of the past, we feel that now is the time to set out for you our financial objectives, the targets that we expect that you will hold us accountable to deliver. So how do we define success? We define success by one, driving growth in net asset value per share. Yeah. By generating operating profits, by which, again, to repeat, we mean that our share of excess management fees, that we receive from Helios's funds should at a minimum more than cover the cost of running HFP, so that managing the balance sheet, all the other investment activities essentially are a zero cost activity, or ideally a negative cost activity. So we should be making profits separate from the profits that we're generating on the investment portfolio. And so what should all of that add up for you? I think the first is we aim to compound book value per share at 15% per annum, and to return capital to you by paying a regular dividend. So it's fairly simple, and these are the standards, these are the metrics that we would expect to be reporting back to you on as time goes by. That's how we define success, and this is how we'll measure performance. So how are we doing so far? In the next section, we'll assess our performance over the last year and the key drivers of that performance. I recognize that there might actually be a lot to take in as we go through, the next little period. So what we'll do is, after we report on the overall performance, we'll then look individually at the three legs of the stool. So the first being the value and performance of our balance sheet investments. So what's the actual portfolio doing? And when we're done with that, we'll take a pause, take some questions before we then pick up on the other two legs of the stool. One being net fee-related earnings, right? This notion of operating profitability, and then and then thirdly, carried interest. So we'll take a break in the middle to give you a chance to ask your questions. So as I said just now, book value per share is the primary metric against which we measure ourselves and by which we would like you to measure our performance. And we look at that against a couple of the most relevant, of the indices that we believe are the most relevant and certainly are the most accessible. The three of them being the MSCI Africa Index, the MSCI Africa X South Africa Index, and the MSCI Frontier Markets Index. On an absolute basis, despite all of despite the good news that we think is embedded in what we're doing, but on an absolute basis and on a relative basis, we underperformed in 2023. So book value was down 13%, relative to the end of 2022, book value per share. And that underperformed the MSCI Africa by about 15 points, quite significant. MSCI Africa X South Africa by about 20, and the MSCI Frontier Markets Index by about 25. So not a great year on an absolute performance basis, nor indeed on a relative basis. But let's take a slightly longer historical perspective. And I think when you look at that, you start to see there's some important points to note, which I think support the message that we are indeed at a positive inflection point. So between the Fairfax Africa Holdings IPO and the strategic transaction in 2020, FAH's Fairfax Africa Holdings book value per share declined at a compound annual rate of about 14%, and the share price declined more or less at the same rate, about 15%. Since the strategic transaction, the negative book value trend has significantly stabilized, and we've successfully liquidated almost all of these troubled assets and replaced them with Helios managed investments that are performing well. So average book value per share underperformance versus benchmark has narrowed from about 17 points prior to 2020 to about 6 points post-transaction. But the negative share price trend has actually accelerated since the strategic transaction. And we think, of course, while disappointing, it's not altogether surprising. I think that there's still a lot of complexity that masks underlying performance. And so one of the key objectives that we have going forward, in addition, of course, to creating value substantively in the investments that we make, is looking for ways to simplify the reporting of our performance. So time will tell. We're not, we're long-term investors, as are all of you in this room. And so we're quite confident that once the dust has sort of been cleared and that we've sort of cleared the underbrush, I think, and the story is and we deliver continually and the story is told, I think the share price will reflect that. So now let's decompose the decline in book value per share into its key components. We ended 2023 with book value per share of $4.39. And that's a decline of 13%, as I noted a couple of slides ago. Of that, fair value decline, so like-for-like diminution in value, represented about 42 cents. That's about 65% of the decline, while overheads and other non-investment related expenses represented 19 cents, about 30% of the decline. Again, just on this overheads point, again, to remind you, the objective of getting to break-even NFRE, i.e., earning enough third-party fee income to cover all of the costs of running it, is that effectively that will cease to be a negative number and ideally in future will become a positive number, contributor to value as opposed to a detractor from value. So that's the decomposition of the decline in book value per share in 2023. Oops, excuse me. So this chart shows, make sure we're on the same page. Yeah, this chart shows that the contributors to the NAV change grouped into the buckets you are by now getting more and more familiar with. So the asset management side, that's Topco LP, which being the vehicle through which we receive the fee and carry streams, that's one. And then secondly, the investments buckets, which we've split on this page into Helios managed investments and legacy ones. There are basically 3 points to make on this page. The first is that 100% of the reduction in NAV can be attributed to reductions in the value of Topco. I'll come back to that later. Remember, Topco is essentially the present value of the discounted value of of anticipated fee streams, et cetera, from carry. So it's all about the fundraising environment, the liquidity environment, and so on. But we'll come back to that. So 100% of the decline is attributable to that. Now, so that's the first point. The second point is that on the investment side, the Helios managed investments showed a total increase of $83 million. That's 77 cents per share. But of that, not all of that is a like-for-like increase. The like-for-like increase is the 18 million that you see in that sort of reddish color. So 18 million in like-for-like appreciation in value, while the remaining $65 million was essentially new dollars invested. So that's point number two. And the third point is that while the legacy investments show a $31 million reduction in value, virtually all of that was from actual liquidations. And only a very small portion, I'm not sure you can make it out, but the really small reddish sliver at the bottom of that box was a like-for-like reduction in fair value. So the takeaway from that last point is that even as we're liquidating the legacy portfolio, we continue to preserve value on them. This is the point I made earlier about this not having been some kind of a fire sale, just get it all out the window. So that's the overall the decomposition of 2023 performance on an NAV basis. So summarizing, investments and cash grew. The value of Topco, the asset management side, fell materially. And the net other assets essentially made up the balance. So the next question is, how does this performance translate to our view on the fair value of HFP? Right? So we've seen what happened on to the book value. What does that actually mean for fair value overall of HFP? So you'll recall, sorry, I'm just out of sync here. So you'll recall this framework from last year. We measure value using a relatively market standard, at least for firms of this sort, market standard sum of the parts approach. The first part being the value of our balance sheet, investments, and cash. I think that's straightforward enough. The second is the value of the profit-generating potential of the asset management business. Again, profits generated in excess of all of the costs of running HFP, valued on a PE or DCF basis. That's part two. And the third is the value of our share of carried interest in Helios funds that already exist. So I'll just remind you that in the valuation of Topco LP, the component that measures the value of carried interest is really only relevant for funds that already exist. There's no value given to them for funds that Helios may raise in the future in the going concern of its asset management business, of which we would receive a share. That last part we put in a different bucket, which is what we call franchise value. The fact that the Helios funds exist, and if all goes as expected, will continue to exist, and therefore forevermore, HFP will be entitled to a share of the carry. So we'll go through the first part, just the balance sheet investment, and then we'll take a short Q&A break to enable you to ask, and those online to ask the questions that you may have. And then we'll go on to cover the other three parts of this. So let's talk about thinking issues. Great. So here's a very good news story. You know, at the time of the strategic transaction, the investment portfolio of $218 million comprised, obviously by definition, 100% legacy assets. We've been making really good progress along the way, divesting those assets and replacing them with assets that we do believe in, the Helios managed investments. And so when you fast forward to the end of 2023, and those legacy assets are now down to 14% of the portfolio, having been replaced, you know, the remaining 86% being Helios managed investments. What's also very good news is that we've executed, as I mentioned just a couple of minutes ago, on that liquidation process at a pretty good pace while preserving aggregate value for HFP. Some of the value that we preserved/created came from realizing value from the individual holdings at or close to the carrying values at the time of the strategic transaction. And a good portion of it came from the portfolio insurance deal that we did with Fairfax in early 2021, the value of which is reflected in the gain on what we refer to as the HFP derivative. I mean, just to cast your mind back, at the time when we got really into the detail of the existing portfolio, we had a view that there was probably more risk in that portfolio than met the eye. And so we negotiated an agreement with Fairfax Financial under which they issued a debenture. We issued them some warrants, and of course paid interest on the debenture in return for essentially locking in the valuation of a portfolio of those assets. I think that's proven to have been a good thing for us to have done, because that's created a fair bit of value for HFP. So overall, we've achieved a recovery rate of more than 90%. If you sort of take that 218 that we started with, how much have you sort of been able to hold on to? More than 90% on that legacy portfolio. And now we're down to one single asset, which is Nova Pioneer, the education business, which I think is no secret. We're also in the process of trying to divest. That asset, Nova Pioneer, is valued at $17 million, as you see on the slide in front of you, the gray portion of the 2023 column. And the remaining $15 million of value simply being payments that are due to HFP from deals that have already been struck for the sale of our residual interests in AFGRI and Phil-Africa and related assets. So this is quite good news, we believe. We see more good news in the Helios managed investments, which are performing well. So in total, there are $198 million spread across 5 discrete investments. First is Helios 4. This is Helios Fund 4, into which HFP has made a $50 million commitment, much of which has been drawn down, some of which is yet to be drawn. That fund is focused on the conversions of demographics and technological innovation across the continent. It focuses on consumer, non-discretionary, digital infrastructure, financial services and fintech, and tech-enabled business services. On a like-for-like year-on-year basis, the fund was up 28%. And of course, our share in that fund is what we're referring to, so up 28%. Trone is a co-investment with Helios 4 in what is the largest medical equipment distributor in Morocco. Again, that was also up about 7% year on year. That's Trone. The third is HSEG, Helios Sports and Entertainment Group, which is a permanent capital vehicle dedicated to the sports and entertainment industry. that's in that vehicle. Included in that, we have investments like the partnership with the NBA in NBA Africa, Event Horizon, which has now been reconstituted and renamed the Malachite Group. So if you see that in the financial statements, that's what that is. And Zaria Group, our investment partnership with with Masai Ujiri in the entertainment zone space across the continent. That was also up 3% during the year. But again, we believe that there's actually a lot more value creation that's happened in that portfolio than the 3% reflects. And we hope that during the course of this year, we'll be able to have some of that, reflected. Fourth is Helios Digital Ventures, which is the seeding of a venture fund ahead of raising third-party capital. They've made 4 investments, if memory serves. And in totality, that's up about 6%. It was up about 6% last year. And last, but by no means least, is Helios Seven Rivers Fund, which is the hedge fund I made reference to. If you recall, at the time of the strategic transaction, FAH had a portfolio of listed equities on its books. We actually felt that, by and large, it was a decent portfolio. We felt it needed a bit more active management, being a public portfolio of liquid stocks. It needed more active management, perhaps, than the portfolio was getting, and certainly than we, as private equity professionals, could dedicate to it. And so what we did was, in the seeding of HSRF, which is run by 2 gentlemen I think you would have met last year. You certainly met one of them last year, Ahmed Zweiter. We contributed those public assets and some cash as well into HSRF, which is managed on a dedicated basis by that team. I think they started running that in around March of last year, and just in those 9 or so months of 2023, they were up 16%. So they're doing quite well. We're pretty optimistic about the performance there. So good news on the Helios managed investment side. So just to rewind to the prior page, you'll recall, we think we've made really good progress liquidating the existing portfolio. We're down to 1 investment and essentially some receivables. And the Helios managed investments all seem to be on a pretty good track. As for cash, that's relatively straightforward. Our balances are driven really by investing activity, investing or divesting, and by overhead. So overall, the cash balance was down about $30 million year on year. So summing it all up, we ended the year with tangible investments and cash of $319 million, comprising $32 million in legacy assets, Nova Pioneer and the receivable that's associated with the divestiture of AFGRI, $196 million in Helios managed investments, and then $96 million in cash minus $7 million of net other assets. So if we go back to to this framework, or sum of the parts framework again, that's part A, as you can see. The value of the balance sheet investments in cash, $319 million, and then we can we can sort of take the other building blocks as we go. But again, having sort of thrown a lot at you, we thought maybe it would be good to just take a couple of minute break on for Q&A. And maybe I'll have Luciana, Baba, and Belinda join me, and we'll take any questions that you have, and we'll also be able to read some off the screen for those who've put some questions in online. So just to take us back, I hope we're still you haven't lost the train of thought that we're trying to set up. So we've covered now the first part of the sum of the parts. That's the value of our balance sheet and investments and cash, which we said was $319 million. So now we'd like to talk about the second part of it, which is net fee related earnings. And again, just to jog your memory, that's the excess of management fees that accrue to Topco over the HFP operating expenses. And so we'll talk, and then of course, to the extent that that's positive, that you apply a DCF or some sort of a market-based PE multiple to assess what might that be worth. So let's look at that next. So this you would have seen as a slide last year. I mean, the concept of NFRE does not exist, explicitly in the financial statements. And so how do we relate that back to the financial statements? The first thing that we have to do is to isolate the share of excess fees from Helios funds, just isolate that as a distinct number, and then isolate the recurring operating costs that you need to offset against that, and see what the net of those two things are, and that's your NFRE. So as you'll see in the second, actually if you go to the far right column on the page, in 2022 we registered an NFRE loss of 11.9 million, right? You can see that at the very far right of the page at the bottom, $11.9 million loss. And that loss expanded in 2023 to 13.1 million, right, as a loss. So as you know, our objective is to make that a sustainably and increasingly positive number. So how do we plan to do that? First, let's diagnose the problem. We had I think a really good exchange on the question that was asked during the last Q&A session about sort of the fundraising environment. So first, let's diagnose the problem. At the time of the strategic transaction, we did not anticipate NFRE to be negative, certainly not to the extent that we have seen. So what happened? Well, very simply, the size of Helios's fourth private equity fund, the one that was raised in 2020, or that was being raised in 2020 at the time of the transaction, at the time of the pandemic, fell significantly short of its target, as the COVID pandemic made it virtually impossible to market the fund as normal, in addition to COVID, upending financial markets, more generally. So the chart that you see here shows the path of gross fee income from PE funds at Helios. And the one point to note for those who might not be familiar with PE funds is it's quite normal for fee income to decline over time once the funds become fully invested. So you start with, sort of 2% or whatever the applicable percentage might be, applied to the size of the fund, and that's more or less flat through the investment period of the fund, which could be 4 or 5 years, in some cases a bit longer. And then once you get past that period, it starts to sort of taper off until the maturity of the fund. So the track that you see in the blue, the gray, et cetera, is quite normal. Now, so the top of the orange segment shows what the total gross fee the top of the orange shows what total gross fee revenue has actually been, right? So in 2023, that was about $25 million. That's the top of the orange segment. That's the actual, about $25 million. The top of the light gray segment shows what it would have been had the Fund 4 target been achieved, right? So the difference there is $14 million, which completely offsets that NFRE loss that you'd have seen. So had that fund been raised at the target that was set, we would have in the leading years, we would have actually had an NFRE profit most likely, and we would now be tapering down to sort of towards NFRE break even until we went out to the market, until Helios went out to the market to raise new funds this year, which would then layer on the fees. So this is the root of the problem. So COVID was obviously a shock, as we mentioned, but again, as we were discussing a few minutes ago, the fundraising environment for emerging markets has actually been challenging for a long time before that. Declining rates and inflation in financial assets in developed markets, meant that investors just didn't really feel, institutional investors just didn't really feel the need to look elsewhere. But again, that seems to be changing with the realization dawning that, relying on an investment strategy that's predicated on access to, large amounts of cheap leverage is just no longer the no-brainer that maybe it once was. So we're now seeing a subtle but positive shift in sentiment that we think could support the ongoing round of cycle of fundraising. But we know from Helios is not leaving this just to market conditions to improve. They've taken a number of actions that we believe will actually prove to be very beneficial. The first is Helios has invested quite significantly in increasing its fundraising capabilities. So if you go back to 2020, there was one full-time member of the team focused on capital formation or marketing, as you might call it. Now that number is 5, and I know that they're probably seeking to expand that further. So just increasing the capacity for fundraising. The second is also expanding the geographic fundraising outreach to include certain markets that we have seen actually to contain real strategic interest in learning more about Africa and actually investing in it. These are sort of longer, it's a slow burn and then it sort of takes longer to kind of, to turn into actual dollars, but we see a lot of potential in these markets, specifically Japan and the Middle East. So Helios is making a concerted effort. There have been several trips from many of us, from a couple of us here in this room, to Japan and to the Middle East over the last few years, and that's really gaining some traction. And then lastly, launching these new synergistic and thematic investment vehicles that, the Climate Fund, which is called CLEAR, Helios Sports and Entertainment Group, HSRF, the Hedge Fund, and HETI, that are really more aligned to the increasingly specialized, needs and appetites of institutional investors. So we think that these actions that Helios is taking will prove to be beneficial in terms of, addressing that gap that gap in fundraising that has led to this NFRE loss that we've experienced. So now I'll run through in the next 3 slides just a quick summary of the different funds that Helios has underway. The first on the left side of this page is the 5th private equity fund. That has a target of $750 million. The fundraising for that is underway, and the Helios team is looking forward to achieving a first close of that in the coming couple of quarters or so. The second is the Climate Fund, CLEAR, which is focused on decarbonization, resilience, and adaptation. That's a $400 million target. Again, fundraising is well underway for that one, and we hope to be able to report any good news on that in the coming months. On the venture side, Helios Digital Ventures, this is backing technology entrepreneurs, disrupting key sectors of the African economy. It's a $125 million, fund, $125 million target, I should say. Fundraising for that is also underway. And HSRF, it's not a private equity fund structure, it's a hedge fund structure, so it's open. Although they have not gone out yet to raise third-party capital, they've been investing the capital that HFPC did. I mentioned the 16% performance last year, which was very good. And if performance continues to be strong, they will then open up to third-party capital sometime during the middle of this year. And the final 2, Helios Sports and Entertainment Group, we touched on that a couple of minutes ago. They're in the process of raising a new round of funding, with a target of at least $75 million of additional capital from third parties. That's a permanent capital vehicle, so the way that new money will come in will be at some hoped for uplift to the existing carrying value of the investments that HFP has made in the assets that we touched on. And then lastly, Helios Energy Transition, also a permanent capital vehicle. The closest comp I think that we can think of for this is probably New Fortress Energy, something which is a U.S. listed energy infrastructure business. And that's, the capital raising for that is underway. The team that's in charge of that doesn't have a clear sense yet for what the quantum of the capital that will be raised will be, but I think that will become clear in the next couple of months. So it's 6 different vehicles in the market. It's a lot, but the capacity to raise the capital within Helios has grown meaningfully since 2020. So what happens if this is, excuse me. So what's the upshot of all of this, right? So on the left side is just the chart that we went through just a few minutes ago that shows again the $14 million gap being essentially more than 100% of the NFRE losses. This is the fee. These are the fee. These are the fees that are attached to the different strategies that are in the market right now. So on the private equity side, it's a 2% fee. That's what the 4th fund was. That's what all the prior funds have been. The Climate Fund is also a 2% fee, again, on the $400 million target capital raising. The same on the venture side. In fact, in venture, you do see in some cases, especially for smaller size venture funds, you do see fee structures that are actually above the 2%, but I think the target here is the 2%. And then for sports and entertainment, for HSRF and for HETI, for energy transition, these are a different kind of animal, and so we'll see where those come out. Sports and entertainment will be more of a cost plus kind of management fee structure. Helios Energy Transition will be a fee that's based on the asset value or the market cap of the assets that are being developed in that portfolio. But so this is the intended path to get to positive NFRE. So if Helios is able to achieve these fundraising objectives, what effect might that have just numerically on NFRE? As you saw on the previous page, most of the funds that are being raised attract a 2% fee. And typically, the marginal profitability on incremental fees is in the 40 to 60% range. For the more mature private equity strategies, it could actually be higher than that. Whereas for some of the newer strategies, it'll probably fall at the lower end of that range. So if you take a range of sort of new incremental AUM from $1 billion or so to $2 billion, the targets that are underway right now will fall into the middle, more or less into the middle of that range. So $1 to $2 billion. You apply that fee level and an incremental margin of 55%, being that the PE side is a higher margin and it's kind of the largest of it. The additional fees generated would more than cover the $13 million NFRE loss and generate profits of about $2 to $7 million. So if you see the highlighted numbers in the middle, that's how much is the incremental fee, subtract the $13 million loss that we incurred last year, and what is the net of that. So you can see that, again, all predicated on the success of the ongoing fundraisings, but the notion of positive NFRE is not miles away. So if Helios is actually able to achieve this kind of positive NFRE, well, how might that be valued, right? So this, again, it's not a long-term objective. This is a relatively near kind of relatively near-term ambition. So how might that be valued? Well, fortunately now there are increasing numbers of comps, still not very many, but there are a few that are listed, primarily in the US, but a couple in Europe as well. And this is sort of how, on the top of this page, you sort of see how they trade, anywhere from about 10 times earnings to sort of high teens. What's a really important point to make, though, is that these numbers are actually quite conservative because these are the trading multiples of the companies overall. In reality, they trade themselves on a sum of parts basis, and analyst coverage will typically assign a multiple to the fee streams, their NFRE, that is different to the multiple that they assign to their carry streams. And the fee stream multiples are often twice the trading multiple, literally twice the trading multiple of the whole company. So if you're focused on NFRE, really the multiples that we ought to be applying should be quite a bit higher than these. But be that as it may, take these numbers, and of course, there are many advantages that these companies have, advantages of scale, of diversification, et cetera, that HFP does not have. And so you've got to, I think, take some haircut to those multiples. But however you sort of cut it, we think that in the near term, if these fundraisers are successful, conservatively you could be adding $20 to $80 million, probably more if you apply the real multiples of present value to just on the NFRE side. And if you achieve that, remember that now means that you will not be, there's no leakage, if you will. In fact, the NAV, the balance sheet, is hopefully growing, and you're actually supporting that with additional income coming from third-party sources, which we think is a very interesting equation.
These are big fundraising targets. What might be a base case by the end of the year, how much you might raise?
Well, look, I think these, as I said, these are the targets, and typically the fundraising, the way the fundraising cycles work is that they are, from when you achieve I think you're quite familiar with this, but from when you achieve a first close, typically in all of the funds, the traditional, the venture fund, et cetera, you'll have another 12, you can keep the fund open for another 12 to possibly 18 months, right? And so while these are and by the way, whenever you achieve a subsequent closing, the fees that accrue to the GP are backdated for all the subsequent closers. So while, for example, on the climate fund, which has a $400 million target, it may not be the case that they raise all $400 million this year. But so long as they have a first closing this year and ultimately raise $400 million, they'll effectively have fees that are 2% on 400 dated from the date of the first closing.
So what would be a possible goal to have raised by either the end of this year or a year from now or 18 months from now?
Well, we'd say 18 months from now, I think we would believe that all of those targets would be met. That's the objective. Whether it's by the balance of the year, I think quite hard to say. But I think, as I said, the objective is to get to the target within the fundraising period of the respective funds.
When would shareholders start to see progress on that, whether it's this quarter, next quarter, a year from now?
I think you should certainly expect to see progress within the next couple of quarters, definitely.
And you'll report that you raised X amount, or how will
Yeah.
shareholders know how you're doing?
I think, look, you will definitely see the progress. There'll be markers, and I believe we can report that as and when. Julia, correct me if I'm wrong. I think to the extent that, these are funds that are disclosed to be in process in marketing. So I think I don't see why we would not be able to inform at the next, inform shareholders as to where they are. Or please tell me, Julia, if you feel differently.
No, I mean, I think we updated in our MD&A for Q4, so we can
Yeah.
look at moving that forward on a quarterly basis.
Okay. So that's, A and B. Now let's talk about carried interest. And carried interest is, there's a lot more volatility to this, obviously. And there are two ways that we, again, you'd have seen this last year, but there are two ways that we can assess the value of carried interest that HFP is entitled to. One is a simpler way, right, which is simply to take the value of Topco Class A, right? That's the discounted present value of the expected carried interest that will accrue when the existing funds are fully invested, fully liquidated, et cetera, right? So that's a number that one can read off the financial statements. The other way to think about it is to look at, which is a much more conservative way, which is to look at just what we call embedded carry. So if you just sold all of the assets in the funds right now, this very minute, what would happen, right? Now, so those are just two different metrics. There's no magic, but those are the bookends, if you will. And then we'll come to sort of D, which is a different thing entirely. So over the course of 2023, embedded carry, i.e., if you just liquidate all of the funds right away, what do you get? Was down significantly. Now remember, that is down significantly, 82% to $8 million, right, on a year-over-year basis. The driver of that is declines in the carrying values of those fund portfolio assets, and probably most importantly, the catch-up effect of the hurdle rate embedded in those funds. And so forgive me, I think because this will be familiar to most people in the room, but for those who might not be familiar with it, the way that the private equity the private equity funds work is that there's an annual hurdle of 8% in almost all of them. In fact, in all of them, it's a compounding 8% hurdle. And so when you're earning a share of the profit above the capital and that return, there's a lot of volatility when the returns are, the closer you get to sort of an 8% compounded return on the investment itself, the greater the volatility in the carry that you might expect. So if the fund is expected to return let's say 10% IRR, and you've got an 8% hurdle, then you do the math and you can figure out what our share would be. If that 10% goes to, let's say, 9%, there's a really big shift in terms of the value. So there's a lot of volatility in that number, and just as it went down, it might go up, right? So I think but it's a volatile number. But that's sort of what happened. If you take down the carrying values, right, of the existing investments, and the reason the carrying values get taken down is because the comps, for example, comparable companies, the valuation metrics, whatever it may be, you apply them, you take down the value. There's a huge levered effect on the value of embedded carry. So that's the one bookend. And alternatively, you look at the value of Topco A, which is down $55 million on a year-on-year basis, and that's due to increases in the discount rates that are applied and revisions to the exit forecast of some of the underlying funds. So these are the two sort of bookends. But again, these are only for deals that have been done, funds that exist and deals that have been done. There's no value for the going concern or any of, for example, the funds that we went through just on a couple of pages ago. The carry that might arise from those is not on this page. It's not included here. There's no value given to those. So that's part C. The book ends $8 million to about $55 million on the carry, and then we go to the final part, which is the franchise value. As I mentioned a minute ago, on the funds that we went through, there's no values being ascribed to the carried interest. But hopefully, as I mentioned, we'll come back to you at some point soon, give you evidence that Helios has actually made progress in raising these funds, and when those funds get raised, I think it's safe to assume, it's an assumption, it's safe to assume that they will generate carry at some point. And these are the carry structures that these funds will attract. So 20% for the venture fund, 20% for the climate fund, 20% for the PE fund, the fifth private equity fund. In the case of Helios Sports and Entertainment Group, it'll be essentially, think of it as you might sort of a management stock option program. So Helios Fairfax Partners will have a share of the gains above the valuation at which the new money comes in, which again could yield some significant value in time. And in the case of the energy transition vehicle, that will also be in a similar format. So we think of these kinds of things and things that might not be on this page that Helios might pursue as being sort of franchise value in some respect. So just to kind of tie it all together, right? How does this assessment of sort of fair value actually relate to the market value of our shares? Well, it's clear to us at least, and I hope to you, that our shares are actually quite meaningfully undervalued. And to the extent that Helios is able to achieve the things that they've set out to achieve, that we've itemized on these pages, will become increasingly undervalued unless the share price actually starts to recognize it. So on a sum of parts basis, we believe that the current fair value today, conservatively, is in the $350 to $450 million range. And that excludes any attribution of value to what we call franchise value, right? Versus our current market cap of about $300 million. Now that the legacy issues are behind us, right? And I think the momentum of the new investments, the Helios Managed Investments, are going to start to come through. And then if we can simplify the reporting and enable greater clarity into what's actually happening, which I think we'll be able to do during the course of this year and certainly into the next fiscal year, we think some of the good news that's embedded in this business will start becoming manifest, and we're pretty confident at that point that the share price will increasingly start to reflect value. But in a nutshell, we're extremely, I hope that you've gotten the message now that we're extremely excited about where we are. It does really feel like we're at this positive inflection point. I think that there are no more, we're not really, I think, burdened by a lot of the challenges of the past. And we think that the future is looking extremely bright for HFP now.